Thank you for having me. I'm next in line here, yeah? Yeah, and that's me. Check. So great to see everyone, and thank you for having me. Beautiful.
Hello.
No. Hello. Hello. Okay. Then we'll get started again. No, thanks for having me. So my name is Fredrik Hjelm. I am the CEO and also one of the co-founders of Voi. It's the fourth time for me at the VNV days. So most of you probably know Voi by now, either from these presentations or from seeing our e-scooters and e-bikes out in any of our more than 100 cities all over Europe. Quick recap of Voi. I founded a company around 5 years ago. We founded a company with a vision of changing how people move around in cities. What we saw was that the cities had started to accelerate the move towards a greener future, repurposing space from cars, roads, parking lots, and so on, into space for pedestrians, to bike lanes, and so on. What we also saw on the consumer side was that increasingly consumers are moving away from the privately owned car, as we heard from Nico and the team, into various forms of shared mobility, including ride-hailing, including carpooling, more eager to use e-scooters, e-bikes, and so on. And we see that especially among the younger mobility users. So these two trends, both on the city side and on the user side, have really been the mega trends that we're building Voi upon. I was standing here at the VNV days a year ago, then we were in New York. I looked back at my presentation. We promised a few things. 1, improved margins and profitability. 2, that we would win a few really big cities and launch them. And 3, that we would continue to win both with riders and with cities. I think we've checked most of those boxes over the last 12 months. And it's been a really good year, actually. So I'll tell you a bit more about that today. So the micromobility industry was an industry and is an industry with a slightly bumpy start. I'm the first one to admit that. We saw both some missteps on the regulatory side. A lot of capital went into the industry, both to good players and to bad players. And we heard skeptics asking, will this ever be profitable? How long will the vehicles last? Is this a fad and consumers will move away after a couple of months? I think what's very encouraging now to me is that recent performance for us, for Lime, one of our peers, and perhaps someone else, is really starting to prove that this is an industry realizing its potential. We've seen positive movements on the regulatory side. We have seen very remarkable improvements on the profitability side, and we continue to see consumer demand going up year after year. Starting on the consumer side, we've seen a quite incredible demand increase coming out from COVID, both for scooter rides and for bike rides. We're looking at scooter rides here. We've seen a compounded annual growth rate of 120% over the last 3 years. Most of you, if you live in any European city, have probably seen this in your day-to-day life. We continue to believe that this trend will continue for the reasons I mentioned before, both repurposing of city space and also change behavior on the consumer side. At the same time, we have seen a shift from what in the beginning was a quite unregulated market, a Wild West market to some extent in certain cities, to a more structured market. We see cities giving out licenses, cities giving out tenders to the highest quality operators. We have been advocating for this since day one. We think it creates better dynamics for the consumers, for the non-consumers in a city, for the cities themselves, and also for the operators because it creates predictability. We are leading on tendered market share in Europe, and most recently, back to what I promised last year, we've had some big wins. We won London and are launching and rolling out London on Monday. So there is a lot of work happening in London at the moment. We won Vienna, we won Oslo, and several more. Over the next coming 6-9 months, we have some major markets up for grabs, including Brussels, Milan, Berlin, and many more. We feel that we are well positioned for those major markets and continue to see this trend accelerating as cities want to be a part and work together with us as companies. As you know, the capital markets turned more tight end of 2021 as in the beginning of 2022. And we have seen the real effects of this in many of our cities and countries. We have seen peers consolidating their footprint, pulling out from cities, from countries. We have seen a quite big opportunity in several of these countries and cities. One example here being Bird, our US peer who left Germany last year, leaving, say, around 10 million euro revenue on the table. We have been able to capture a disproportionately high amount of this as other operators are leaving the markets. So overall, we have seen more an easing on the competitive pressure side, and we'll continue to see that, we think, over the coming 12-18 months, for capital market reasons, for efficiency reasons, and so on. I'm also a big believer in focus and that this is a business model with local network effects. So you want to be number one or number two in every market you're operating in. If you are number one, or in some cases number two, you get the most rides, you get the most revenues, you can drive your operating cost per vehicle per day down, increase efficiencies, reinvesting in that to build scale in every city. And we are currently number one or number two in 94% of the markets, number one in 76% of the markets. This will continue to be key for us going into 2024 and onwards. We'd rather go to fewer markets, but do it really well, than spreading out too thin. On the cost side of the business, we have managed to decrease the operating cost per vehicle per day with 50% from 2021 to 2023. This is a business model and industry where everything matters. So it's hardware, it's software, it's connectivity, it's operations, it's regulations, and every little detail, every little basis points matter. We've built a culture that is both very data-driven, also very excellence-focused, and the combination of very data-driven operations is the big drivers to what you see here. It's all about everything from when you swap the batteries, how you swap the batteries, when you do the repairs, when you do predictive maintenance on the vehicles, when you take the vehicles into a warehouse, how do you run your warehouse, and so on. And all of this compounds up to what you see here, and what we think is a very, very important advantage versus many of our peers. On the vehicle side, since we started this company 5 years ago, we have iterated through 6 scooter models. You see 5 of them here on this page, and 3 e-bike models as well. And the early generation vehicles that we put on the streets in 2018, they were more consumer-grade vehicles. And the development and progress to the latest generation vehicles that we're operating today have been really, really big. It's not only the robustness and the sturdiness of the vehicles. We have been able to increase the lifetime up to 5-6 years on the recent vehicle models. And we've also added on a lot of smart technology to make the vehicles into really robust sensors, to be able to feed back that data then into all our systems, to innovate on the consumer side, to innovate on the cost side, and also on the city side. How can we optimize parking? How can we optimize flows in a city? How can we improve safety? So where we are now with the latest generation vehicles, we see that the unit economics and profitability works at scale, which has been really, really encouraging to see for us. And these two combined, so a reduced operating cost per vehicle per day, increased lifetime, and vehicle price that's been relatively the same, constant over the years, had driven significant uplift in what we call LTV over acquisition cost of vehicles. We have tripled it from 2019 to 2022. And going into 2023, we see further improvements here as we improve margins. And you should expect this one to continue to grow over the coming years. Going into 2022, we also started to tighten the belt and reduce cost centrally to get to profitability faster. And when you look at where we are today, compared to where we were at the peak cost run rate early 2022, we have decreased cost with 20 million euros on an annual run rate basis. Some of you might have heard this from other portfolio companies as well, but I would say that we are a better company now than ever before. It's a leaner team, we get more throughput, we're more efficient, it's less middle management, stakeholder management, and so on, and we can move faster. So we have taken down the overhead cost as a percentage of revenue from 55%, as you see in 2021, to being around 28% to where we are today. And all of this, of course, compounds up to stronger financials. And we are on the track this year to our full year of EBITDA profitability. What you're looking at here is 21 full year numbers, 22 full year numbers, and 23 last 12 months up until August. You continue to see that we're growing in 2023, and typically H2 is our best year. So you should expect an uptick here, both on net revenues, on gross profit, on market EBITDA and EBITDA versus the last 12-month numbers. And year to date in 2023, in August, we are EBITDA break even. We've improved margins on the EBITDA level with, I think, 32 percentage points year over year. And this, of course, also trickles down to EBIT, one layer below the EBITDA margin. So overall, feel really happy with how we kind of shifted gears from end of 2021, beginning of 2022, and now we're starting to see that all of that is paying off in margins and profitability profile for the company. VNV was our first investor 5 years ago. I met Per 8 years ago in Russia at Avido, and then VNV and some of the Avito people were the first investors in Voi 5 years ago. From my side, I couldn't imagine a better partner. I always refer to VNV when other founders are asking me who should I talk to for my next round, independently of stage. They have helped us a lot throughout the years, rolling up their sleeves when needed, stepping in when needed with various types of support. We've used the VNV network also a lot over the last couple of years, both on the company side, on the recruiting side, on the investor side. Quite a few of the people that we have hired and the companies we have worked with, including BlaBlaCar over the years, are through VNV. Quite a few of the investors that we have brought on in later rounds are also through the VNV network. Over the last, say, 2 years also, since the market changed, it's been really, really valuable for me as the CEO to have people like Per, Keith, who both are on our board of directors, who have seen boom cycles, who have seen bust cycles, and seen them several times, and have helped us to kind of keep calm and carry on. Looking at 2024 now for us, as you hear, I'm very enthusiastic of where we are now. I've been running this company for 5 years. I've never felt as confident as I am today with our team, with our kind of unit economics, with our product market fit, with the regulatory side, as a lot of things have improved, moving into a more mature industry. So focus areas for us now going into 2024 will be, one, to continue to grow with good unit economics, to be able to take the company into full EBIT profitability, not only EBITDA profitability. Continue to ride this wave of car-free cities that I talked about in the beginning. We want to continue to be the best partner for cities and the best service for consumers, and help accelerating this shift. We will continue to explore M&A as well. We have looked at quite a few M&A opportunities over the last couple of years. We have said no for various reasons, but think there might be interesting M&A opportunities as some of our peers, both direct ones and indirect ones, are starting to be in tricky situations. Last one here also, as we're moving into profitability, we are focusing a lot now on how we can optimize our capital structure. So how can we grow the company in the most capital efficient way, both when it comes to dilution for shareholders, when it comes to using non-equity solutions, and of course also the proceeds we will start see coming out from the business now over the coming years. So 5 years in, I'm ready for another 5 years. I think in 5 years from now, we have moved even closer to what you see on this photo, which is a rendering of Marseille, the French second biggest city, and how Voi could look like in a city like Marseille. So that's it from my side. Super happy to be here, and hope you liked it. Thank you.
There we go. Thank you very much, Fredrik, for the presentation. So just as the last time, if you have any questions, just raise your hand. We have our first question already.
Yes, hi. Can you talk about the arbitrage between owning a scooter and renting one? And do you see some user attrition to ownership, basically? That's the first question. Second one, pipeline of tenders in Europe. And the third one, more of a detailed question, the situation in Vienna, which I think you've won and is challenged, if I'm correct.
Okay, so we have 3 questions here. We have the arbitrage, ownership, and shared services. We have Vienna, and what was the third one?
Pipeline of tenders.
Pipeline of tenders. Okay, where to start? Let's start with the simple one, Vienna. So yeah, we won the tender in Vienna earlier this year. We have launched Vienna. We did it in July. It was under challenge for a couple of weeks, but that case has been put down. So we're operating. Vienna looks like a very promising market so far, no issues on the regulatory side. Tender pipeline, I spoke a bit about it. We see a wave of larger important tenders coming up now, or we've really seen that over the last year or so. Closest in the pipeline, as I mentioned, Milan, Brussels, Berlin, among the biggest markets. But there is also a long tail of markets across Europe. And the third question there on ownership versus using shared services. I think in the beginning we were a bit afraid of that. Everyone will buy their scooters or buy their e-bikes instead. I think what we have learned over the years is that that's rather good for us, because if a person buys their e-scooter or if they buy their e-bike, it shows that they really like kind of the form factor, and there will always be use cases when it's just inconvenient to bring your own bike, to bring your own scooter. So we see them rather as complementary than a substitute.
Great. I think we have one more here, if we can.
Yes, thank you, Jan. Was very nice. On the revenue growth, there seems to be a bit of a slowdown. Is that simply because you have been winning less tenders, you've seen less growth in markets uptake? What is slowing it down? So that's one question. And if you are forecasting revenue, are you really looking into simply stacking cities, or do you also see actually revenue grow over time within these cities because you add form factors, or you renew the tender, or you win the tenders again? So how do you see revenue expanding? Yeah,
no, great question. So the slowdown in growth between 2022 and 2023, I mean, it was a conscious decision. We went into 2022 really to focus a lot on the excellence side of the business, on the profitability side of the business, not scale as fast. So that's a result of that. What we see on the revenue side, which makes me very optimistic, is that when you look at kind of net revenue per vehicle per day over the years, so same store sales, we see that is increasing with say 15-20% from 2022 to 2023. So we continue to see that there is a lot of upside still on how much we can get out of the vehicles every day. the overall growth will be a function of the number of vehicles we put out, of course, and that, so the net revenue per vehicle per day. We are currently in 110 cities in Europe. We think there are approximately 450 attractive cities in Europe alone. So we've just scratched the surface on what this can become when it comes to our footprint. And what we're also seeing is that in many markets we're able to go deeper, increase the fleet size, and increase the revenue we get per city from year 1 to year 2 to year 3 as the user base matures and becomes bigger. As we're sorting out regulations, able to scale to like suburban areas and things like that. So the growth over the coming years will be a combination of three things really. We go deeper in existing cities. We continue to drive up net revenue per vehicle per day on the existing fleet, and then we will go to new attractive markets as well. And attractive markets for us now in the stage we are in today, meaning markets where we see payback, where we can get to profitability relatively soon.
Okay, just a follow-on question on that one. So in terms of market size, what is an attractive market for you? What are apart from this one, is there like a minimum size, or is there a particular configuration of a city that works best for you?
Yeah, that's also a great question. In the early days, we thought there would have to be a kind of minimum population size for a market to be attractive, in terms of profitability and so on. I think what we've learned over the last years is that since we've driven the operating cost per vehicle per day down so much and improved kind of how we run the whole operations of the business, now we can operate in much smaller markets as well, long tail markets with 20, 30, 40,000 people living in them, which we couldn't really do in a good way in the early years. So take Stockholm as an example in Sweden. So from Stockholm currently we're operating 7-8 cities, so within an hour and a half, 2 hours drive from Stockholm. Since we don't need to take the vehicles in every day, as we had to in the beginning, we're operating with swappable batteries. The vehicles last much longer. We don't need to touch them. We don't need to touch them that often. So total addressable market for us today versus 3, 4, 5 years ago is much, much larger thanks to technological and operational improvements. And what was the other part of your question?
So are there any configurations of cities that simply make it a go or no go for you?
It's a bit the same there. In the beginning, we went to a lot of markets, tested a lot in the north, in the south. Back then, due to technological and operational constraints, we didn't really make it work in all markets, so we pulled back from some cities. Spain was one example, which was the first market we launched in after Sweden. Then we paused Spain for a year and a half, then we came back, new product, new way of operating, and now it works really well there as well. But overall, of course, the larger the city, the more attractive it is to some extent. But then there are lots of variables on kind of how does infrastructure look like, how do substitutes and complements look like, how strong is public transportation, are people used to bikes, are they used to mopeds? So a lot of variables go into that one.
Thank you.
Great. Just one question from me. On a previous slide, you showed a bunch of competitors that have left several cities in Europe. I think a key question is to understand what makes Voi different from the rest of the players. Why don't you have the same issues, so to speak?
So it comes down to what I talked about in the presentation. It's a business where everything matters and excellence really, really matters. So if you're slightly better than your peers and competitors in on the operation side, on the hardware side, on the software side, on the connectivity side, and so on, that compounds up to both an advantage on the user side, so we're able to drive high utilization, which leads to higher net revenue per vehicle per day, which further drives down the operating cost per vehicle per day, which also gives you a cost advantage on that side of the business. And what we see now is like this obsession about details, obsessions about being data-driven in the way we run operations has compounded up to this advantage, where we see that we can operate the business on a city level, on a country level, more efficiently than most of our competitors can in most situations.
I think we have one question from the web here.
Yes, one question from the web. Could you please elaborate on depreciation and amortization in this business model? How to think around cash flows, and basically when you're going to reach cash flow positive and positive?
Yeah, so cash flows in this business is a bit simplified, EBITDA minus capex every year. So EBITDA will be operational cash flows, and then the other cash flow the other big cash flow item is on the capex side. We, as I said, are likely moving into EBITDA profitability this year. Soon thereafter, if it's next year or the year after that, we should move into EBITDA minus capex or cash flow positive as well. And that one over time will harmonize quite well with EBIT as well.
Great. We have one more question from there. Let's see.
Hello. Very quickly on Paris, the situation here is very different.
Sad.
Yeah, but what do you make of it? Obviously, we're not there, so you're not responsible. But
Yeah.
well, do you see a future where we come back to scooters?
Yeah. So for context here, Paris is the first city, I think, in Europe that passed the e-scooter scheme. They did it a couple of weeks ago in September. The build up to this was a referendum earlier this year, where I think 5% of the 5% of the eligible voters went to vote, and it became a no. We don't see that trend spreading anywhere else, to be honest. As I said, we've had great success in some major markets: London, Vienna, Oslo, and several more this year. We're having some of the other ones coming up later this year: Milan, Brussels, Berlin, and more. What we hear from Paris is that it's paused, it's not cancelled forever. So we really hope that the Paris scheme will come back in 1 or 2 years from now.
One more maybe up here if we have time.
Oh, hey, I have a quick question. What is the cash payback cycle on the new scooters?
Say it again, Keith.
The cash payback cycle? Like how long does it take for the scooters to pay for themselves?
Yeah, great question. So when we look at it on a group level, it's we're down to less than a year. When we look at it in our best markets, we're down to a couple of months until we have fully paid back the vehicles. After putting them out on the streets. That's been a great development as well. And as I mentioned in the presentation, the vehicles last 5-6 years when we look at the latest models.
Sorry, just a question on the M&A. Just wondering how it makes sense in this business model. Is it not better, for example, to, let's say, go and win a new tender in a new city? Why do you think it's better to consolidate?
Yeah, the arguments for consolidations would be around to get to scale and footprint faster. If you feel confident that you're able to integrate the other company on your platform, and related to that, access to good licenses, tenders in certain key markets. So it's scale and access to footprint play.
Sure. Just a quick follow-up. With regards to some of the pushbacks that you have had from some of the cities, what are some of those major pushbacks? Did you have to do a lot of changes to your to either to the vehicles or to the approach, the business model, etc.? Yeah,
so when we go out talking to cities, and we talk to a lot of cities, we see that what cities care about when it comes to micromobility is it's safety, it's parking, and also kind of how we run all of the operations. They call it antisocial behavior, or people double riding on the vehicles and so on. We have invested and built a lot of technology over the last couple of years to be able to solve those pain points as well, which to some extent are the key purchasing criteria for cities. So mainly around parking, mainly around safety, mainly around antisocial behavior, how people are misbehaving on the vehicles.
Thank you.
Great. Just a final quick question from me. If we look at this picture and you dare to give us some more color on where is Voi at this point in time in terms of revenue, in terms of margins, in a, let's say, a blue sky scenario?
On what time horizon? Do we have
5 years? I think
okay,
you
so
said.
we have 5 years. And so when we looked at where we're taking the business over the last 3 years, we have tripled on revenue since 2020. We have taken the company into EBITDA break even. So when we look at where the company could be in 5 years, I think we should be able to triple it again and operate with very healthy EBITDA margins, EBIT profitability, and cash flow positive.
Great. Let's end it with that.
Let's do it.
Thank you very
Thank
much,
you.
Frederick.